Hello, everybody, and welcome to the Like channel. So happy to have you join us, dear tortoises. And what a day in the stock market! The markets are rallying across the board on the back of the softness that came out of Washington after Trump threatening to wipe out Iran from the map. They now backpedal to some extent, and they agreed to a 2-week pause. Yeah, and that means that it was also agreed that the Straits of Hormuz will be reopened and there will be a safe passage. So this will happen. This will happen for the next 2 weeks. It remains to be seen whether this resolution has come to an end. I unfortunately I still think this is good news, but only for the short term because they haven't come to an agreement yet. I mean, yes, it's going to last 2 weeks, but what's going to happen afterwards, right? That's just short term. I mean, do you have like something solid that will stop any conflict going forward? That's what remains to be seen. But anyway, the markets are rejoicing. As you can see, oil prices are plunging in the markets. Both the S&P and Nasdaq are both rallying sharply, and so are many of our positions, which is nice to see. So guys, today's video, I want to tell you about I received some messages, right? And I know that this can be quite confusing for people who are probably getting started in the stock market. And you guys feel overwhelmed by data, you feel overwhelmed, and you don't know exactly what to look for. Because I've been in your shoes. I faced the same difficulties at the beginning of my journey, and I know how crippling that can actually be. And that leads to another bias that we call analysis paralysis, right? So we start looking at so many sources, so many different types of data, and then we forgot the most important thing, which is to act, to take action. And this video is for you. Many of you watching this are also busy professionals, right? So you all go about your daily lives and you have your full-time jobs, which makes it even more difficult for many of you to juggle these different commitments and to actually keep track of your portfolios while at the same time stay focused on your daily jobs. But this framework, guys, helps you do that. All right. So I'm going to share with you exactly what I would do if I start from nothing. So if I were just completely new to investing, if I had to learn everything from scratch once again, I will tell you exactly what I would want to see. All right. And I think, in my humble opinion, because this is exactly what happened to me, this will save you time, which is important, right? Time is definitely our most precious assets, but it will also save you a ton of money. And I know people who have come to me who blew up their accounts because they lack a strategy. They lack a solid framework. So hopefully we will be able to stop that by with this video that we are putting out. I'm recording this on April the 8th, and hopefully you guys will find a ton of value. And if you do, please smash the like button because it does take a while to put these videos together, and that would really help us grow and spread the word, which is what we want. Thank you so much, tortoises. Okay, so what would I do? Exactly because I know how overwhelming all of this can be. I mean, you really lucky is the person who stumbles upon the right data, right? Who stumbles upon the right framework from the very beginning. And I wasn't that fortunate because I really had to make a lot of mistakes, and I just had to find my way around investing and find a strategy, a framework, find principles that actually resonate with me. And so from almost the very beginning, I realized that trading was not for me. Just to give you an example, it was not for me because I was working full time and I wanted a more hands off approach to investing, but at the same time, I wanted to maximize my returns. Okay, so how do you find the right balance here? Because I was meant to believe that in order for me to be very profitable in the markets, that I would have to be literally glued to the charts. Right? That was the big misconception at the time. I would have to do this as a day job, like most professional money managers do. And that could not be further from the truth. It depends on what strategy you are using. But the strategy that we implement here and that we preach on this channel, it's all about finding great businesses that meet certain quality criteria, and then we want to buy them with a big margin of safety. And if you do the things that I teach, what I found over time is that this you can perfectly beat the stock market over the long term while still going about your daily lives and only devote, say, an hour of your time per week towards your investments, which I think is very reasonable. I mean, ask yourselves this question. Do I think doubling my money every 3 to 4 years, right, is worth an hour of my time per week? Of course, I would say yes every single day, right? Not least because not only are we maximizing our returns, but we are also minimizing your downside by investing with a huge margin of safety, which is exactly what you want, what I like you guys to do. And this is what I tell my clients to do as well. And I teach them on the frameworks and strategies that allow them to do that. Okay, right. So this is what I would want to see, everyone. The 4M investing framework. I've devoted hundreds of hours studying books, investing in my own education by attending workshops, by buying online courses, and I think I don't think I'm pretty sure that the framework, right? So the principles that were detailed by Benjamin Graham about 50 years ago or so are just they are time tested and they make sense today. They will continue to make sense in the future. All right. And then, of course, Warren Buffett built upon those principles and framework. And in this 4M is just, how can I say, it's a simple way to distill all of that into a single, into a core framework, if that makes sense. Okay. And obviously, over time, based on all the research that I've done and all the books that I've read, I implemented a few things to the 4M strategy that can really make the difference for. They have certainly made a difference for me, and I'm pretty sure they will make the difference for my clients. But I will share with you exactly the framework with you guys so that you guys understand exactly what we want. Right? This will allow us to filter out all the rubbish companies that just are unprofitable or don't meet our criteria for quality, and we will stick with those companies that are very high quality. That those are the ones that we want, and we are not looking for the next Amazon, because this framework will prevent you from doing that. If you follow this framework to the core, what you will find is that you will end up with a basket of well-established companies, well-proven business models. They have nothing else to prove. All right, those are the companies that we want. I mean, why are you, especially if you are running a concentrated portfolio, it should be a high conviction portfolio. So why would you buy rubbish that is not well established? Like, I don't care whether revenues are like exploding at 30 or 40% per year if the business is only around for 3 to 4 years. That doesn't create the moat hasn't been proven, and that's what I want you to guys to understand. The longer a business is operating, the longer that moat will have had to prove itself, and this is what we want. Okay, the 4M investing framework, a simple system for long-term market beating returns. Most investors fail not because they lack intelligence, but because they lack a clear, repeatable process. The 4M framework solves that. It helps you focus on what actually drives long-term returns, and that is great businesses, strong advantages, capable management, and disciplined pricing. All over YouTube, you will find many people that are called quality investors, and they agree with these strategies. In fact, they make their investment decisions on the back of these fundamentals, on the back of these quality metrics. The only I'm just more conservative when it comes to paying for this quality, but we will cross that bridge when we get to it. So this is the four M's, as you can see right here. All right. Starting with a meaning. What the heck does that mean? And I hope this makes sense because I build this and hopefully you will be able to understand it quickly because investing is, after all, simple but not easy. What is the meaning? The first M, do you understand what the company does? Do you understand how the company generates revenues? The revenue split, the geographic split. Those are the questions that you must ask. How does the company make money? And in addition to that, something that is left out by everyone, because I don't see anybody on social media talking about that, as I already alluded to. Do you like what the company does? That should be the first question. If you don't like what the company does, it doesn't matter what the company how the company generates how the company makes money. I would never invest in a company I'm not interested in. All right. That is part of your meaning. You have to understand that. Meaning, do you like, would you be proud to own that company outright if you bought it today? That's it. That is meaning, right? Right. And then you have the moat, the competitive advantage. Does the company meet criteria in terms of financial strength and predictability? Financial strength and predictability. These are important traits of a very successful business model in the long-term compounder. And this, for example, also resonates with Terry Smith. He has been preaching over time, and he practices what he preaches because he only invests in well-established companies that have some predictability in their numbers. That's what I want. And when you do that, what you will find is that there are certain industries that will be left out entirely. And those include high capex industries like airlines, for example, the entire commodity sector, includes also banks. So where there is a lot of volatility, I just avoid those investments. Not to say they are not very good investments, don't get me wrong, but I because they haven't because the industry on the whole hasn't achieved great returns on capital relative to the cost of capital, right? So if you look at the ROIs of certain industries over decades, you will see that these industries tend to generate lower ROIs. That's why, because I'm a long-term investor, I avoid them altogether. Management, look for CEOs who are owner-oriented, driven, and totally transparent about what's happening within the company. The same way I take for granted that the same way I am pretty sure my clients expect me to be transparent with my process. I expect the management of companies that I trust my money with to be fully transparent with what they are doing with my money, how they are allocating capital. Okay, this is what it comes down to. And what about the track record? Have they created a lot of shareholder value over the last few decades? Those are the questions that we are asking. And last but not least, the company can meet all of these three M's, but if it doesn't trade with a big margin of safety, the like a tortoise margin of safety that we require, then it remains on the watch list, but certainly not in the portfolio. I don't care how great the company is. All right. So let's delve deeper into each and every single one of them. Meaning, understand the business first. Before anything else, ask, do I truly understand how the company makes money? This is what we should look for. Simple, clear business model, predictable revenue drivers. And you can make the case that there are companies in the Like a Tortoise portfolio, for example, Alibaba, that don't have a clear business model. They are more complex. All right. You have to understand that. But the reason is I understand the business model. They have different revenue streams and I understand it. But if you don't understand how the company makes money, if you cannot explain it in simple terms, you should not invest in it because there are businesses simpler to understand than others, right? Everybody knows how Lululemon makes money. Duh. It's very simple to understand, right? I mean, compare that with Alibaba. I mean, it's incomparable. So Right, long-term demand for its products and services, and this comes back to the company being. So I want the company to operate in a secular, in a very strong secular market. In other words, is there strong demand for what they are selling? If the answer is yes, then that is definitely a big green flag because I want to see that. I want to see that the company has plenty of reinvestment opportunities. And that is why the industry the company is in is also very important. Why it matters? If you don't understand the business, you won't have conviction. You will panic when the stock drops. You will rely on noise instead of fundamentals. And by the way, speaking of being busy as well, think about the reason I think so, because I see that with my clients. The reason you guys continue to believe investing takes so much time is because you pay attention to things that are not worth paying attention to, and that includes headlines. Headlines are sensationalist. They are meant to price you out of your stocks, right? Otherwise, how are they going to sell their stuff? Exactly, but they are the enemy of a long-term investor. They add nothing. They add close to zero to so because these people are focusing on the short term, and you as a long-term investor are focusing on the long term. It's the long term that matter, and so by focusing on the fundamentals and ruling out all the noise on the headlines, you will find a lot of time in your hands to actually focus on what really matters. And that is the underlying business, right? And all it takes is about an hour per week on average. If you don't understand, you don't. So if you don't, we already discussed that, I think. If you don't understand the business, you won't have conviction. You will rely on noise instead of fundamentals. Exactly. Like a tortoise principle. If you cannot explain it simply, don't invest in it. As Peter Lynch said. And notice how I'm quoting many of the most successful investors of all time. Is because I read them and I built the framework based on their input. It's like the best of every single one of them that I just I incorporated into this strategy. If you can't explain it, it's simple. Don't invest in it. As Peter Lynch mentioned, if you can't explain what a company does in, say, 10 minutes, then, I mean, you shouldn't invest in it. As simple as that. Moat. Why this business wins over time? What will stop that business you are investing in from being disrupted by competitors? A great business is not enough. It must be able to defend its position. Types of competitive advantages, there are several of them, as you know: pricing power, strong brand network effect, switching cost advantages. The most important one is this one right here that I'm about to highlight in yellow: network effects. Okay. And what I find, or more often than not, is that when a business does have a strong moat, you will find a combination of different modes, which is staggering. So, for example, Apple. Apple has pricing power. They have a strong brand. They have switching costs. I mean, try to convince my girlfriend to swap out to swap out her Apple phone. Is just, I mean, good luck with that, right? So when the moat is very strong, you usually see a combination of different modes. Very good. What to check? High and consistent margins over time, strong returns on capital, durable market position. As you guys know, many of the companies that I invest in have collapsed 50, 60, sometimes even 70% from their all time highs. But however, the business has a moat still, right? And in addition, I like, typically when I start deploying, when I start building that position, you will see that these profitability metrics are already turned the corner. That's what we want to see. I want to see plenty of catalysts, right? Which is very important. I want to see catalysts. Maybe the business has different exits, which is even better. That is the case of PayPal, for example. PayPal operates a buy now, pay later business segment. They are also in crypto. They are also providing lending services. They are also You have the branded checkout experience. I mean, they do different things. That is very, very good. And some of these segments are growing above 20%. So we have different exits. I like that. And typically, for me to invest in a turnaround, I want to see profitability going back up at least on a quarterly basis. That is a catalyst, okay? Those are the things that I'm after. What to check? So that is why this matters. Without a moat, competitors erode profits. Growth doesn't translate into returns. Another thing that I learned over time, companies that can convert most of their earnings into cash flows typically tend to outperform. This is very important. You want companies that have high cash conversion ratios because earnings are can be more easily manipulated than pure cash. Very hard to manipulate. Management, and so you can see only invest in businesses that can stay ahead, not just grow. Who is running the business? Who's running the show? Even great businesses can be ruined by poor management. What to look for? Smart capital allocation. Track ROIs, ROS, ROI, all these capital allocation metrics over time because they tell you how well management is deploying capital. Excuse me, for example, Royce, they will tell you how effectively management is using its capital, right? It's investing capital to generate profits. That's what we want to see. The higher, the better. Smart capital allocation, long-term thinking, honest communication. Are they like avoiding something? So if the numbers are telling you one story, but then the management is painting a completely different picture of the business, man, that is a red flag. That's not a yellow flag. That, in my world, that is a red flag. They are hiding something, right? Something is not well with the business, and they don't want shareholders to know about it. Key questions: do they invest profits wisely? Do they avoid unnecessary acquisitions? Acquisitions are often used to mask a declining business or a deteriorating or to mask deteriorating fundamentals. Why? Because when a management team embarks on acquisitions, they will grow the top line revenues. But under the hood, you can see profitability getting hit if there is no synergy between those acquisitions. So, do they prioritize shareholder value? Are they thinking long term or short term? And most importantly, how is their compensation created? So, are they compensated to drive long term returns? In other words, do they get incentive bonuses on a per share basis, right? Is it linked to ROIs, for example, or is it linked to earnings per share? This is a huge difference because what a management team can easily they can find ways to prop up earnings in the short term at the expense of deteriorating fundamentals down the line. So ideally, you will want to see compensation packages tied to capital allocation metrics like ROIs. That would be perfect. Okay, why it matters? Management decides where capital goes, how growth is achieved, whether value is created or destroyed. Like a tortoise principle, bet on people who think long term. Margin of safety, last but not least. Margin of safety, because price is what you pay, value is what you get. Even a great company can become a horrible investment if we end up overpaying, right? So yes, price matters. What to look for: discount to intrinsic value, reasonable assumptions. I'm always doing this, everyone. So it just blows my mind when I see people projecting cash flows to grow at 25% over the next 10 years. This is absolutely mental. I mean, seriously? Are you really using any conservative assumptions in your models? This is horrible. It's not good. It's not. I mean, these guys. I mean, you shouldn't be doing that at all because you have to account for the uncertainty. And if there is any recession in 10 years, and yes, on average we see a recession once every 10 years. I mean, what's going to happen to those growth rates? Yeah, they will plummet, and so will the stock price and the multiple. This is what I mean. And so typically, because I project out 10 years, I don't like to use above 15% growth rates in my assumptions. Okay, and so yeah, this will offer you downside protection. And then once I determine the real value of a company, I don't buy it at intrinsic value, as you guys know. I buy it with a 50% margin of safety. Why it matters? Reduces risk, so it accounts for all the vicissitudes of life, as Charlie Munger said, increases potential returns at the same time, right? Many of you will think, oh my God, look at that, the stock is down 60%, it's going to go to zero. Guys, I mean, if you think like that, then, I mean, what can I say? The like a tortoise strategy is definitely not for you, and you should be chasing the shiny object instead, right? I mean, good luck with that. Good luck surviving in the markets long term. But yeah, what I found, and there is plenty of research on this, is that when you buy a quality business with a big margin of safety, you are reducing your downside while maximizing your upside, because even even if the stock just go back to its intrinsic value, we are not even saying expensive, right? In this market, everything is almost expensive. But we see many opportunities in quality companies that are trading below its intrinsic value. And when you buy it with a big margin of safety, the stock going back to its intrinsic value is enough for you to triple your money. Get doubling and tripling your money in a very short period of time, right? Okay, this is incredible. And protects against mistakes. Think about it this way: it's very difficult to project with certainty. In fact, it's not difficult, it's impossible to project with certainty what the company is going to do over the next 10 years. And that's why once you determine the intrinsic value, you should divide that by two to get your margin of safety entry price. Because by doing that, we are already accounting for all the risks that can happen, and that includes, for example, our assumptions that can be off. Buy great companies at the right price. So how it all comes together, the four M's work as a filtering system, right? Do I understand it? Is it defensible? Is it well run? Is it worth the price? Slows deliberate decisions, high conviction, long-term horizon, consistency over activity. Consistency over activity. You don't need hundreds of stocks. You need 10, 15 great ones chosen well. And if you do that work well, you can go about your life and sleep, and you can go about your life and sleeping well at night, because you own well established companies that meet our quality criteria, that you purchased with a big margin of safety. Okay, that's it. So when things like this happen, the Iran war, which nobody could have predicted, then even though many stocks, shiny objects, are crashing big time, right? Your stocks you are still in the green because you have bought with such a big margin of safety. I hope that makes sense. Okay, guys, and this is it. So this is exactly what I would love to have stumbled upon at the beginning of my investing journey. And if you apply this framework with every single one of your investments, you cannot help but make money. I want to be as transparent with you as possible. You cannot help but make money. You cannot mess this up. It's not going to happen. And you know why? Because when you have a portfolio of 10 companies, say 10 companies, you don't need all of them to perform very well in order to beat the market over time, right? And that is, so you can even if 3 to 4 positions in your portfolio do nothing, but if the other ones play out exactly as you expected, and you rinse and repeat, you're going to end up making a lot of money over time. And that is precisely what I want for you, dear viewers. And last but not least, another thing that would have helped me substantially is having a very good checklist to keep everything in check. And I created this for our clients, but I think I already created a video on this. It breaks down the meaning, the mode, so everything that I'm looking for within meaning, within mode. So you will complete this checklist for every single one of your investments, and you have everything in a single place, right? When you want to revise that investment thesis. So guys, yes, I hope this helps. Let me know if you liked it, and if you want to know more information about our program, just let me know as well. Yeah, this I'm always very transparent about my process. And speaking of which, if you go to the description, you can download you can download the free resource, which is the 4M framework with many important insights for you. It's completely free. So speak soon. Stay tuned for more.